So we have had such a great session. It's a real honor to chair this session. What I'm going to start with, I want to tie this work first to the work that was already done, and I think these three papers add a lot to expand what we know about extreme weather and what banks do in these circumstances. So maybe it's good to first think about what was done before, and then I can tell you how these papers add, and then I'm going to maybe push the authors a little bit to think about policy implications of the work they've done. Their papers are widely applicable to both small and large banks. I'm going to emphasize for each of them how their findings apply. Okay, so we know more or less of the direct effects about how extreme weather effects, how extreme weather events affect bank lending. There's many studies, and I think I have listed just a few here, have shown that banks are likely to lend more after extreme weather events, and that banks generally accommodate whether these are households or firms in the area that are most affected by the natural disasters. So basically we also know a little bit about network effects. So banks, large banks especially, export liquidity from areas that are less affected or that are not affected to areas that are most affected by these events. And so in many studies, this has been emphasized as a benefit of having worked with a large bank that has a national presence. Okay, there's some newer work also that shows there's some risk sharing, whether that's done through securitization or whether that's done through other ways. But I think there's many ways for banks to actually respond to these events, and there's many buffers that are built into the system here. Okay, and then I want to talk just a little bit, just a sentence or two about the real effects of these extreme weather events. So there's this really great paper from the Fed by Taran and Wilson. It's a fairly recent paper. It studies how employment wages respond to these extreme weather events, and they look at exactly the first 8 years after an event hits an area. I think this paper, we would have to keep it in mind. I think they find that both employment and wages drop suddenly around the time of the event, but then they recover more than the level they were at prior to the event. So I think overall you see more activity, more economic activity in the longer run. Okay, so with that in mind, let's talk about these three great papers and how they fit into all of this. So I'm going to start in order, and I don't have much time, so I'm just going to say a few words about what each paper has done. So the first paper on wildfires that Sean gave, really a great paper, shows both direct and indirect effects of the wildfires, which I love about the paper, right? You need to see both of these type of effects to make sense of the overall effect of these events. So number two, we don't really know that much about wildfires, and I think that's one of the first papers in the area. I think the authors should emphasize this a little bit more and how important wildfires are. So the only thing that they may have to improve upon a little bit is the areas. This indirect area that they look at is too small. I think their results, they sell their results a little bit short because these wildfires have a wider impact than just the 20 or so miles that they look in around. Okay, so basically what I want to push the authors to think about is how these wildfires affect the financial institutions in an area that's affected by wildfires, right? So far, they're their evidence comes from the Y14 data, which is mostly large banks, right? And I would like to see a little bit more about like smaller community banks in the areas that are affected. I know you don't have as great of a data for those, but I think you can do more, like in that sense. You can see quarterly lending across groups. You can assess how like risky these banks' portfolios are. You can do more here, right? Because what I worry about here is just there's certain households who match with these large banks and are more likely to have a loan from these large banks than other types of households. So I think this is something that you need to address to assess the overall impact. And then the fintechs, I think, is something that you really need to look into as well, because they've really like expanded lending, especially around the time frame that you're looking at. Okay, so I think one of the main like reasons I want you to look at fintechs and smaller banks is because of this newer strand of work that shows that there is substantial amount of risk sharing among like banks and non-banks, or large banks and smaller banks. And so this is a venue that I would like to see more, to see ultimately who bears the risk. Okay, so the other stuff I think we can talk more about later in the interest of time. The final thing I wanted to say is, so you look at a fairly short time frame, and I know this is because the Y14 data doesn't go that further back, but I'm wondering if you can expand the panel at least like back to 2010, because wildfires are like a bigger deal now, but I think we always had wildfires, and they always pose the risk to the local community. So I would like to see a little bit more about a longer sample, and then like events that are less severe, because as you saw, Justin's paper kind of shows that if you look at these really large events, you get one set of results relative to like smaller and mid-sized events. Okay, so in the interest of time, let me go to the second paper. So I love this paper, really careful work in terms of the FEMA data. It's really like refreshing to see they don't use the standard data set Sheldus, which has many issues. And they basically have done a really careful work also on how to assess the impacts. They actually use the exact same statistical technique as like this paper that I mentioned for the real effects paper. So they assess basically how basically natural disasters or these extreme events affect like lending in an area in the 8 years, like after each event. And the other thing that the paper does is uses interstate bank regulation, deregulation to like as a shock to basically the share of local banks. And so, okay, so a few words on this paper. Really great paper. We learned a ton from it. I love the econometrics here and how the authors have done it. One like request I have here is like, I think we should focus on a simpler specification without these interactions and without, looking at the like IVing local bank share. Why? Because I just want to see how things evolve, like without this IV, because I'm skeptical about the IV, which is my second point here. I think there's some recent work showing that deregulation, like especially in this setting, is not that exogenous. In this paper that I cite, Baker et al. Here, they find evidence on only one dimension, but it casts like a lot of doubt on the setting. So I think I would like to really see if you can do something different, like in terms of the IV. I honestly think you have a great paper even without the IV, so you don't really have to go at length. And I think these linear projections, they can help you like isolate what the effect is in like markets where you have more local banks relative to less. It's just the interpretation is not going to be causal, I think, but you can get around this with more tests that you can do. Okay, so on the last paper here, I'm going to just say a few words. Really nice paper. Like again, it expands our like understanding of like how government programs work. Like in this space, which is really like important, which is something that I think we just don't know enough, right? Whether the funding that we get after like an extreme event is enough or not, like whether we need to do more or less and so on. So I think this paper kind of sheds light on that. And we saw that after the like introduction of the national program, things work so much smoother here in the space. I think what I want to see from the paper is a little bit more like whether this is optimal or whether like we need to like scale some of it back. I think some of the tests indicate that deposits grow like maybe too much, but I can talk with the author about this, right? And so do we have like an overall like expansion of like lending in other spaces like because we're overdoing these government programs? So that's something that her paper can easily answer, and I think it's not in the paper yet. So that's what I want to see. The other thing that I wanted to see in this paper, and I'm going to end because I'm out of time, is the like response to these events. I want to see whether these events cluster in time. I can see how if you have a drought one year in a given county, you're probably more likely to have it in the next year. So I want to see how the serial correlation is going to affect what you find, because drought is not like the other types of events that the two other authors study, that are sudden and fast and like you have a sudden impact. This is slower. So I worry a little bit about anticipation effects in this setting. With that, I'm going to end. And I'm going to give the chance to Andy Anderson, who is the CEO of Bank of Anguilla, to say what he thinks about these papers. Thank you, Andy.